Everyone. Hope everyone is doing well. Thank you for joining me today for another webinar. Today, we'll be going over types of investments and investment accounts. To quickly introduce myself, my name is Brandon Chan. I am a wealth manager here at Cetera Investors. I have been doing this for nearly a decade, helping individuals and families with everything finance related. Wanted to jump quickly through this because we do have a lot of information. Wanted to squeeze this all in within 30 minutes or so. So, without further ado, love to start. And the first thing I'll be going over today is actually in regards to types of investments. So I do have a quick general overview of this topic right here. So an investment is essentially an asset purchased with the expectation that will be generate income or appreciate over time. Now, all the investments I'll be going over today have unique characteristics and unique traits that make them special. One thing that they do have in common is that they are all tools within your own financial tool belt to help you grow your army of dollar bills. So, the actual investments that we go over today are actually going to be these six right here: stocks, bonds, mutual funds, exchange traded funds, or more commonly known as ETFs, real estate, or I'm sorry, investment trusts, and lastly, alternative investments. So, the first one that we're going over today are going to be stocks. Also known as equities, these are a type of security that represents ownership of a fraction of the issuing corporation. So, more commonly in the industry, or out in the world, you're going to hear that these units are units of stocks are more commonly known as shares. So I have 10 shares of Apple or I have 100 shares of Meta. That's what we call them in the industry itself. So these stocks are bought and sold predominantly on the stock exchange. Now, of course, you can find privately held stock and buy them, sell them with the issuing corporation themselves. But like I said, predominantly you'll find them on the stock exchange. Think of like the New York Stock Exchange or the London Stock Exchange. And for many individual investors, stocks are the foundation of their portfolios right there. And there are actually two main types of stocks: common stock and preferred stock. I'm not going to be going over kind of the ins and outs of each one, but just keep in mind there are two types of stocks. Like I said, common and preferred. But there are many types of investment styles when it comes to stocks themselves. More commonly, you'll hear growth stocks or value stocks. On the other side, you'll also hear maybe small cap, mid cap, or large cap stocks right there. The next investment that we'll be going over today are going to be bonds. So these bonds are essentially debt instruments representing a loan made by an investor to a borrower. More commonly, these borrowers are either corporations or governments. So think of companies or essentially our own United States government or even international governments as well. And these bonds actually have bond rates, or more commonly known as coupon rates, which are issued by the borrower. These coupon rates are essentially the percentage that they're going to pay out in dividends, or I'm sorry, interest to the borrower, or I'm sorry, to the investor who has lent the money over to the borrower. Now, the borrowers, corporations or governments, use the money that was lent to them to help finance their own operations, purchases, or even other projects right there. Keep in mind, the coupon rates, as well as prices of the bonds at which you buy them or sell them, are essentially determined by interest rates right there. The next one that we're going over are actually going to be mutual funds. These are investments where one or more investor pools their money together to purchase securities such as like stocks, bonds, other things of that nature. And many of these mutual funds do have portfolio managers on the back end side managing all the stocks and bonds inside, buying and selling everything every other couple days or anything like that. Now, when investing in mutual funds, there may be minimum investments that you need to make. More commonly on my side, I see minimum investments between $500 to $5,000. But there are mutual funds out there that do not have any minimum investment at all tied to them. So you can put just $100 in them. right there. And with these mutual funds, there are a lot of different kind of management styles, and the two prevalent ones are going to be active management as well as passive management. So active management is when the portfolio manager actively buys and sells the securities inside the actual investment, uh, essentially laid out in their own investment objectives. So, hey, if a mutual fund is here for long-term growth, you know, essentially the portfolio managers are going to try and buy and sell different types of securities inside to achieve that goal of long-term growth. Or there could be a goal for income. So, portfolio managers will buy different types of stocks and bonds to generate income for the investor themselves. Now, on the flip side, that's different from the active, essentially, management. There's passive management. More commonly, think of like tracking an index, say like the S&P 500 or the Russell 2000. Portfolio managers are just going to buy essentially whatever's in the S&P 500 or the Russell 2000 index as an example, and just let that ride out. There's not going to be a lot, trades inside the actual mutual fund itself. Now, one thing to keep in mind is that these mutual funds generally have higher costs to them when investing, and that's broken down between yearly management fees as well as front end charges, if any, right there. And last thing to keep in mind is that for these mutual funds, they're valued at the end of a trading day. So essentially, you won't know what the value of the actual mutual fund is until the end of the trading day itself, usually around 4 p.m. Eastern time. And at that same time, at 4 p.m., at the end of the trading day, that is when all the buys and sells are executed right there. The next investment we'll be going over is actually going to be exchange traded funds or ETFs, widely popular now, ever since this past decade. Actually, exchange traded funds have actually outpaced mutual funds in popularity. Now, exchange traded funds are very similar to mutual funds in that they do have active as well as passive management, for these ETFs. Now, one thing that they do have different than mutual funds is that these ETFs actually trade throughout the day on a stock exchange. So, like I said, mutual funds, you only find out what the price is at the end of the trading day. With ETFs, you actually know what the price is throughout the day itself, right there, because it's trading on a stock exchange. And it mirrors the buy and sell behaviors of stocks. So think about like a chart itself. You're going to see the ups and downs of the market throughout the whole day. Now, generally, I do want to say ETFs are more tax efficient than their mutual fund counterparts, but it's not the case for all of them. Like I said, generally, ETFs are more tax efficient than mutual funds. I don't want to go too much in regards to that, but just keep that in mind. Last thing to note is why, maybe ETFs are very popular nowadays is that they generally have more, or sorry, lower operating costs to them than also their mutual fund counterparts right there. The next type of investment we're going over are going to be investment trusts. So these investment trusts are public limited companies that aim to make money by investing in different companies or other sectors right there. The most popular of the investment trusts out there that a lot of people know about are real estate investment trusts, or what we like to call in the industry REITs right there. So as the name kind of alludes to, that these investment trusts actually invest in real estate right there, whether that be commercial property or residential property, anything of that sort right there. Now, generally, these investment trusts are less liquid than ETFs due to their fixed supply of shares, as well as any stipulations they have inside the contract where they only maybe allow you to liquidate every so often, maybe every 3 months or every, a year or so, only at certain batches at a time, right there. So, like I said, with that, it's not like an ETF where you can buy and sell all of your shares at one time. With these investment trusts, you may be limited to what you can sell and when you can sell. Now, the last investment that we'll be going over is going to be alternative investments, and there's a vast, universe in regards to alternative investments right here. But the main popular ones are going to be real estate, hedge funds, private equity funds, commodities, and cryptocurrencies. Now, with these alternative investments, you may be required to be an accredited investor just to be able to invest in them. Accredited investor, essentially what that means is that you need to have liquid, essentially net worth of over $1 million or annual income as an individual around two to $300,000, or as a married couple, $400,000 right there. Now, each firm is going to have their own kind of guidelines in regards to who they allow to invest in these types of alternative investments. So definitely check that out. But these are going to be the main alternative investments right here. Now, like I said, these are the six that we went over today, but there's a lot more out there in the world that are more sophisticated, but these are the ones that you're probably going to see most often throughout your lifetime. Before I get into in types of investment accounts, I do want to quickly go over risk versus reward. And this is something I do have to go over with everyone when it actually covers investing in uh, you know, different types of things. Now, on the top of the actual pyramid, you're going to see what is the most risky thing out there to invest in: speculative stocks, bonds. I would even put cryptocurrencies in this little portion right here. And as you go down the actual pyramid, you're going to find it's going to get less and less risky. And at the bottom, you're going to see the things that you can actually put your money towards to help protect your assets or loved ones. So, such as like disability insurance, health insurance, life insurance, long-term care insurance. But the thing to keep in mind is that as you go up the pyramid, you do have potential for high returns and principal fluctuation. So you're going to see maybe the stock go wildly high and go wildly low at that same time, right there. But keep in mind, on the flip side, as you go down the pyramid, you do have the potential to lose buying power due to different types of risks, such as like inflation, right there. Now, on to the next section of our webinar, which I'll be going over types of investment accounts. I do want to kind of wrap it up in a general overview as well. With all these types of accounts that I'll be going over, like I said, with the types of investments out there, these types of investment accounts also have unique characteristics and unique traits. And kind of same theme is that one thing they all have in common is that they're tools in your own financial tool belt to help you grow your army of dollar bills. Now, with these accounts, they utilize what we like to call the eighth wonder of the world, compound interest. Compound interest. So, the first account they'll be going over today is going to be the employer-sponsored retirement accounts. Most people think of your 401ks, your 403bs, your 457 accounts right here. Generally speaking, these accounts are provided by your employer as an employee benefit. Now, there are a lot more types of employer-sponsored retirement accounts out there, such as simple IRAs, SEP IRAs, thrift savings plans, or what we call TSPs, but it really depends on the employer and what they offer to you. Now, generally speaking, I just want to break down kind of where you're going to find these types of accounts. So for 401ks, usually part of a benefits package, predominantly seen in the private sector, right there. On the flip side, 403b accounts, these are geared towards your public educators. So think of like teachers of public schools, as well as nonprofit employees. And then the third count, 457 accounts, think of your state and local government workers right there. Think of people who work in, city hall, in your own local city, or the county office, everything like that. And then last one, thrift savings plans or TSPs used by federal government and as well members of the uniformed services. So think about your post office worker, mail carrier, those type of peoples, they get the TSP account right there. Now, I do want to go over some benefits when it comes to employer-sponsored retirement plans. And essentially, the first one is that, these accounts, 401ks, 403bs, they allow you to launch your wealth building journey. And the reason why I say that is because not only can you put the money in there, but also your employer can as well, often through a match. Now, the more money you save inside your own retirement account, the more free money that you can get. And the reason why I put free as in quotations is that, sometimes you may be subject to a vesting schedule depending on your employer. Essentially, what that means is that they have a track for you to stay with the company to be able to capitalize on all the match they have given you. For example, if you have a vesting schedule that is 4 years long, every single year that you complete with the company and stay there, you get access to a percentage of the match that they have given you. Let's say, for example, they give you a match of 4% on all your contributions right there. So every year they have a four-track 4-year investing schedule. So every year you complete with the company, they allow you to have access to 25% of your match right there. So if you stay 2 years, then you get 50% of the match that they've been giving you all this time as you put in your contributions. Keep in mind, all your contributions that you put in yourself, not the employer match, is already vested. So you have access to your own money anytime. Just may not be able to take out any of your employer match. That's all it is up until maybe you hit that 4-year mark where then you have access to all of it right there. Now, I do want to go over some rules and limitations when it comes to the 401ks, 403bs, 457, and TSP accounts. For 2024 contribution limits, employees under the age of 50 are able to put up to $23,000. Now, for 2025, IRS guidelines have actually updated that number. For those who are under age 50, they can put upwards to $23,500 right there. But for employees who are over age 50, they're, they actually have the ability to put in catch-up contributions. Essentially, they're able to put an extra $7,500 as long as they're over the age of 50, right there. So, for example, for 2025, if an individual who's working is 55 years old, they're able to put upwards to $31,000 into their retirement account, right there. So that's the $23,500. Add the 7,500 on top of that, $31,000 right there. Now, there are some early withdrawal penalties, so keep that in mind. If withdrawals happen before age 59 and a half, that person may be subject to an extra 10% penalty on top of any possible state and federal taxes that may be owed at that time, right there. Just wanted to put that out there. Now, the second account that we'll be going over are actually going to be individual retirement accounts, or commonly known as IRAs, right there. So for the IRAs, they're not tied to any employer at all, actually just tied to your own name. But to open one up and to contribute into one of them, you do need earned income for the year to actually invest in them. And the two most common IRAs that people know about and we'll actually be going over are going to be the traditional IRAs as well as the Roth IRAs. So I do have this quick chart right here, kind of going over different aspects between the two. So with the traditional IRA in the first line, the traditional IRA is funded with pre-tax dollars. So what that means is that if I invest $7,000 inside a traditional IRA, I get to deduct $7,000 off my earned income for the year. I don't have to pay the taxes on that $7,000. Now, on the flip side, for the Roth IRA, it's funded with after-tax dollars. So that means that $7,000 contribution, I already had to pay the taxes on that, the state, federal taxes, anything like that, on that to be able to invest in the Roth IRA. Looking at a dollar amount, so between the two with the traditional IRA, if I earn $100,000 a year and I invest $7,000 inside, I'm only taxed at not for $93,000 in income for the year. On the flip side, for the Roth IRA, if I made $100,000 and invested $7,000, when I do file my taxes, I have to report $100,000 in income that I'll be taxed on right there. Now, when it comes to, taxes, for the traditional IRA, like I said, all pre-tax dollars invested inside, and as, the account grows, it's tax deferred right there. And whenever I take distributions out of my traditional IRA, I will then need to pay the income taxes on that money. Not only the income taxes of my contributions, but also on the growth as well. Now, on the flip side, for the Roth IRA, I already paid the taxes when I initially put my contribution in. So it grows tax free. And in retirement, say I'm 65 years old, I take $10,000 out. I don't have to pay any taxes on that $10,000. That's just an example of how powerful the Roth IRA is. Now, if you look at the third line right here, you kind of wonder like, hey, which one is the best one for me? And so, if you believe you're going to be in a lower tax bracket in retirement, the traditional IRA is going to be the best option for you. Now, if you believe that you're going to be in a higher tax bracket during retirement, maybe the Roth IRA is going to be best for you right there. Now, one thing to keep in mind is that with the traditional IRA, you are subject to what we call required minimum distributions. What that means is that by a certain age, the IRS is going to start forcing you to start taking distributions out of your account up until the day you pass away, right there. And as of right now, the RMD age is at 73. Now, this has changed the past couple of years due to the Secure Act, and we don't know what's going to be changing to in the future right there. So, but just keep that in mind with these traditional IRAs, they do have RMD rules within them. On the flip side, Roth IRAs, because you are already taxed, you don't have to take any, they're not going to force you to take any distributions in the future at all. Now, of course, still want to go through over some rules and limitations regarding the accounts. First up, contribution limits for traditional and Roth IRAs. So for 2024, contribution limits for those under age 50 is $7,000 right there. And for 2025, it's actually the same amount, $7,000 for those who are under age 50. But hey, what if I'm over age 50? Well, you get catch-up contributions, and it's a limit of $1,000. So for example, if I'm a 55-year-old man, I get to actually contribute $8,000 total into my traditional and or Roth IRA right there. So that means $7,000 plus the extra $1,000 catch-up contribution. Now, very similar to the employer-sponsored retirement plans, right there, think of your 401ks, 403bs, 457s, they do have early withdrawal penalties right here. So any withdrawal before age 59 and a half, subject to extra 10% penalty on top of any possible state and federal taxes that may be owed at that time, right there. And the last kicker with these traditional and Roth IRAs is that they do have income limits to even contribute into them. So, depending on your marital status as well as your modified adjusted gross income, you may be limited to or completely phased out of contributing to any traditional and or Roth IRA. Just keep that in mind. Now, I don't have the income limits in front of me, but that's something that you are able to look up on the IRS website or contact your local CPA or enrolled agent to help you figure out those numbers to see if you are, within that range that you're phased out or, maybe limited to how much to contribute into them. Now, the third account we'll be going over is actually what they call the Health Savings Account or HSAs. It's a lesser known tool that can be used for retirement, but actually wasn't even meant for that at all. To qualify to actually contribute to an HSA account, you do need to have and be, eligible for a high deductible health plan right here. And essentially, for all the money inside this account right here, it's mainly used to pay for qualified medical expenses. So think of like, doctor visits, prescriptions, dentist work, dentistry, anything like that, to help pay for any past, present, or future expenses right there. And fun fact, only 13% of HSA holders actually invest their contributions. Wild. So that means 87% just leave it in cash right there. Now, this type of account, the HSA, in the industry, we like to call this the triple tax advantage account. And I'll go over why we call that. The first tax advantage is that these contributions that you put inside the account immediately get tax deduction off your income. So think of very similar to the traditional IRA, where you put in the contribution, tax deduction off your income right there. You don't pay taxes on that. Now, the second tax advantage is that you can invest these dollars in the stock market, in CDs, anything like that, and they also grow tax deferred right here. So you're not going to pay any of the taxes as it's growing. And the last tax advantage is that when you take out the money to help pay for qualified expenses, qualified medical expenses, that is, or to reimburse yourself for any prior medical expenses, those dollars that you take out are also tax free right there. So, one thing to keep in mind though, with the high deductible health plans with the health savings accounts, just because you have access to them does not mean that it's the best insurance plan for you and your family. Make sure, every year during open enrollment, that's usually happens around October and November time, you choose the plan, health plan that is, that makes the most sense for you and your family and all your unique medical needs right there. So, and some rules and limitations in regards to HSAs, we'll go over the contributions right now, is that for 2024, as an individual, you're able to contribute up to $4,150. Now, if you're a family, you're actually able to put up to $8,300. Now, 2025, they have increased the contribution limits just by a little bit. So for an individual, able to put upwards to $4,300. But as a family, you're able to put $8,550. Now, there are catch-up contribution limits here. Keep in mind, though, for the other accounts like IRAs as well as employer-sponsored retirement plans, the catch-up contribution age is 50 and over. For HSAs, it's actually 55 and over. And the dollar amount that you're able to put in is actually $1,000 right there. Now, the last account we'll be going over is actually going to be the taxable brokerage account right here. In general, this is not a retirement plan in and of itself, but is widely valuable when it comes to retirement or any other financial goals out there. And you can open these up as an individual or as a joint account, maybe with a spouse, anything like that. Now, the benefits of the taxable brokerage account kind of boil down to this. You have full liquidity starting from day one, so you don't have to wait until like age 59 to have to even take a withdrawal. Day one, you have full liquidity. You can put in all the money you want. You can take all the money out if you want as well. Second one, you have no income restrictions. Very similar to like kind of contradictory to the IRAs where you have income limits or income restrictions. If you make too much, you're not able to put any money in there. With these ones, you can make $1 million and still be able to contribute and invest in a taxable brokerage account right here. Now, as the account grows and as you liquidate the holdings, they are subject to more favorable long-term capital gains taxes, which are currently lower than ordinary income taxes right there. And to qualify for long-term capital gains taxes, you need to hold the investment for over a year. And keep in mind, if you liquidate an holding less than a year of owning it, any gains that you have are subject to ordinary income taxes right there. And last bullet point is that this account right here can be a great complement to your overall retirement portfolio. And thinking about retirement, we like to think about it as a three bucket retirement strategy. If you can build your portfolio to have three unique and distinct tax buckets that are the pre-tax bucket, the after-tax bucket, as well as the taxable bucket, you get to pick and choose which taxes you pay in financial independence throughout your whole lifetime, right there. Very powerful. Like I said, to have three unique buckets of different tax, styles, pre-tax, after-tax, and taxable. Like I said, you get to pick and choose from each account what taxes you pay. And that's very powerful when it comes to how much you get to keep as an investor. Now, to get started, highly recommend everyone here sit down and think and answer these five questions. So, what do you have access to with your employer? How much can you put towards your goals? Is inflation going to be a prevalent risk in your kind of goals? And then how much do you need for each individual goal? And how long do you have to save for your goals as well? If you can answer those five questions right there, that can help steer you to which type of account may be the best for you to invest in, as well as what types of investments you should be looking towards to invest in as well. But I appreciate you taking some time out of your night and day for this webinar with me. Hopefully, you got a lot of information from this, and we want to thank you and look out for other videos from us in the future. Thank you.